On the 31st of January this year, the RBI effectively stopped Paytm Payments Bank from all of its core businesses. The stock crashed 20%. The company lost $2.5 billion in valuation. And this company, that's actually a poster boy for the startup industry, that at one point was valued at $16 billion, is now facing regulation and perhaps even worse fate than it's seeing at this point. Has Paytm done something horribly wrong, or is the RBI being anti-innovation and anti-business? Let's take a look. Now, to understand this business, we have to first understand that there are two halves to Paytm. One is the payments app, sort of like Google Pay or Phone Pay, where basically you keep your money in a non-Paytm bank account, in your regular bank account, and you just make payments to this app. Nothing has happened to that business. That continues as normal. Remember that Paytm started a bank. There is where the problem is, the Paytm Payments Bank. Now, the RBI has effectively restricted this bank from taking any new deposits, from conducting any credit transactions or any top-ups. So effectively, it can't do any business. It has, of course, as a saving grace to customers, said that you have until the 15th of March to spend all the money you have in your bank account or to withdraw that money. The RBI has not cancelled Paytm Payment Bank's license, but effectively crippled its entire business. Now, the reason that the RBI has done this has not been clear. The RBI has repeatedly said it was persistent non-compliance and material supervisory concerns that it had with how the bank was functioning. There was a Reuters report that also quoted government officials saying the ED had some concerns, but the company has since then refuted the fact that it's being investigated by the ED for any sort of money laundering issues. Now, RBI's action was met with a lot of shock and pearl clutching from the startup industry and from the founders and the entire ecosystem. They said the RBI's action was effectively anti-innovation, which basically means that you're being so hard as a regulator that nobody will be able to innovate and come up with new ways to do business. It said that the RBI was being tough on business and it was not allowing disruption. And this was fundamentally very surprising. The RBI, in fact, had to have a second presser or a press conference today, on Thursday, where it repeated again that there was persistent non-compliance, that they had given a period of time to the company to correct its problems, that there was a lot of conversation that happened between the RBI and the company, and no changes were brought in. It also said that it is doing this fundamentally to protect customers. Now, here's the odd thing, though. Even though people seem to be surprised at the RBI's action and people are asking if the action is too harsh, it is no secret that in the 7 years of this bank's existence, it has received 5 strikes or 5 penalizations from the RBI. Now, again, the RBI has not been open about the reasons for these strikes or the problems that the bank has had. It's repeatedly said that they have been persistent non-compliance, but there have been media reports, source-based. Fundamentally, this one, if you take a look at it from CNBC TV 18, that actually lists out several problems within that bank. Now, I don't have a teleprompter, so I'm going to read from my laptop. The company first banked its banking license in January 2017. In 2018 June, the RBI froze onboarding of all new accounts because of breaches of day-end balances and non-compliance in KYC guidelines. Since then, take a look at the rap sheet of violations according to CNBC TV 18. One, in October 2021, the RBI uncovered that the bank had submitted false information and slapped it with a fine of 1 crore rupees. After that, the RBI has said that there have been persistent absence of KYC details and PAN card violations. Also, dormant accounts. According to CNBC TV 18, out of 35 crore wallets, 31 crore are inoperative or dormant. In thousands of cases, the RBI found that the same PAN was linked to 100 customers. In at least one case, the same PAN was linked to 1,000 customers. It is also flagged that the total value in some transactions run into crores of rupees, which is well beyond regulatory limits. To that extent, in March 2022, the RBI stopped the company from onboarding any new customers because of non-compliance of KYC norms. In lakhs of cases, accounts and wallets are found to have been frozen by other law enforcement agencies like the ED, for example. Now, like I said, there's no problem with the founder or the company, but there are many accounts that don't have adequate details and so are being looked at for money laundering. In October 2023, and this one's important, the bank was fined 5.39 crore rupees for its faults in compliance regulations. In an interview with CNBC TV 18, former executive director of the RBI, Dipali Pant Joshi, has been quoted saying that the Paytm compliance was a disaster that had been in the making since October 2023, when Paytm was fined 5.39 crore rupees. They were very blasé about the reasons, and they were nonchalant towards the reasons behind the penalty. And despite several violations and communication with the RBI, Paytm continued its operation without solving those problems. So, why is the startup industry so surprised that the RBI finally took this action? There was also apparently concerns about the separation between the ownership of Paytm Payments Bank and its parent 197 Communication, and this is part of RBI regulations. So now here we are. Where does the company go from here? Now remember, this company has 90 million wallet users, 58 million FASTag users, and it's the leader in the wallet business. Now the company will have to migrate its users. The bank will have to migrate its users to third-party banks. Paytm says it will shift its customers to third-party banks, but all of those other banks are waiting for the RBI's approval to be associated with Paytm at all, and so that's likely to take a little longer. There's also the question of disruption to retail customers. 15% of Paytm's merchants, so basically when you buy something from the Sabziwala and they show you that barcode, they are the merchants using Paytm. Now they will have to be migrated also, 15% of them. So which means new QR codes have to be given. They have to be given new transaction IDs, especially where they're using physical stickers and scanners. So there's a lot of work there. Let's take a look at the effect on Paytm. Paytm shares have apparently fallen 41% in February alone because of repeated beatings from the RBI. One Communications Limited has said it's taking immediate actions to comply with the RBI. But here's the thing. There were also rumors carried by many media houses, including the important newspapers, that Mukesh Ambani's Jio and HDFC Bank were in conversation to buy out the wallet business from Paytm. Since then, sources from Paytm and an official statement from Jio Financial have said that this is not happening, that they are not going to do it. Then Vijay Shekhar Sharma, who is considered, he's the founder and the CEO, he is considered close to establishment, actually met with Finance Minister Nirmala Sitharaman in the presence of top Department of Financial Services officials on Tuesday, and there was hope that he'd be able to maybe iron this out. We understand that the Hindu Business Line has reported that the finance minister sent him back to the RBI, and he was asked to go back to the RBI and sort out the matter there. Even the source in the Hindu added that the government doesn't have much to do with the RBI's actions on the payment bank. But here's the thing. This is not a small company. At its peak, it was worth $16 billion. Vijay Shekhar Sharma is a poster boy of the startup industry. Remember, the startup industry is based on the philosophy of disruption of traditional businesses. Mark Zuckerberg very famously said, move fast and break things. If you're not breaking things, you're not moving fast enough. Could it be that this very large company was moving too fast in the interest of innovation? When focused on innovation, should founders lose sight of the fact that by moving fast and breaking things, very often regulation, that the people they're hurting are ordinary people who've put their hard-earned money in their hands? The Indian FinTech industry, which is the financial technology industry, which is basically money that moves on apps, is estimated to be worth $150 billion by next year. That's a lot of money that's moving fast in the interest of innovation and disruption. There are those who are giving small loans on apps. There are those who are taking bets in a betting environment, building fantasy cricket teams, and also running investments. Should the RBI and all regulators at this point be looking a little more closely at the industry that's moving fast to break things with real money from real people?